In today's video, we're going to talk about when does whole life insurance make sense. So I think there's a lot of back and forth from advisors and from clients and from marketing material here in Canada about whether or not you should buy whole life insurance when you're young or when you're older. Should you use it as an investment? Should you buy term or should you buy whole life? There's a lot of confusion around it and there's a lot of different opinions around it. So in this video, we're going to go over when does whole life insurance make sense. And by the end of this video, you'll know exactly if whole life insurance is right for you or not. What's up, guys? For those of you who do not know me, my name is Philip Setter. I'm the founder and CEO of Affinity Life, which is an online life insurance brokerage here in Canada, where you can actually view quotes 100% online and apply 100% online as well. So if that sounds interesting, I will put the link in the description below and you can check that out. But without further ado, let's get right into the video. So before we actually get into when does whole life insurance make sense, maybe I'll just give you guys a little bit of background about maybe term life insurance versus permanent life insurance. Okay, so term life insurance is the easiest type of life insurance to understand. You buy it for a specific period of time, so you can choose a term like a term 10 or a term 20 or a term 30. They actually have term to 65. And essentially, the life insurance is only meant to cover you for that specific period of time. So you're really buying it when your family needs it the most. And usually this is when you're young, you have a family, maybe you just bought a house, maybe you got married, maybe you have kids, you're starting a job, you have car payments, etc., etc. And if something were to happen to you, your family would be very financially impacted. And I mean, it just would not be a good situation. So getting very cheap, very affordable term life insurance to cover you for that specific period of time is relatively easy in a term product. Now, the idea with this is as you get older, 50, 55, 60, your assets start to accumulate. You start to accumulate some investments. And of course, maybe we're paying our house down at this point. Maybe the kids are out of the house as well at this point, and your need for life insurance is really dwindling, possibly going eventually to zero, and then you can cancel your term life insurance. That is what term life insurance is used for. Permanent life insurance, on the other hand, is used for until the end planning. Okay, so term life insurance is a what if. Permanent life insurance is a when. It will happen and it's guaranteed to pay out upon death. So it's meant to cover you all the way until the very end. So there's two different kinds of permanent life insurance. We have universal life insurance and we have whole life insurance. So I'm not going to get into universal life insurance in this video. I did make a lengthy other video describing whole life insurance versus universal life insurance and the differences between them. And if you're interested in that video, just drop it in the comments and I'll send it to you. But here's a quick synopsis. Universal life insurance is a flexible product. It's sometimes relatively cheaper compared to whole life. However, there are a lot of things to manage with it. There's a lot of added complexities and a lot of things can go wrong with a universal life policy. So you do pay for some of those flexibility features. Whole life insurance, on the other hand, is a little bit more expensive. However, what are you getting for those extra premiums? Well, essentially what you're getting is a guarantee. That's the biggest feature of whole life insurance is you're now buying a guarantee. So instead of with universal life, it could go up, it could go down. It might be paid off in 10 years. You might have to pay it for 15. You might have to put more premiums in. With whole life insurance, really that's what you're buying. You're buying a contract that's contractually obligated to end at a certain time. So you can pick a different payment duration, similar to a mortgage. You would pay off a house in maybe 30 years. You can pay off your whole life insurance you can pick an 8 pay, a 10 pay, a 15 pay, a 20 pay. You can pick these different durations and it's guaranteed. So with that, after that duration, whatever you pick, let's say it's 20 years, you now own the benefit. If you passed away within those 20 years, of course, that would pay out. But after that 20-year period, you never have to pay another premium. It's contractually obligated. And whenever you pass away, that life insurance will pay out. Now, with both types of permanent life insurance, a universal life insurance and whole life insurance, there is this investment component. So with whole life insurance, that's known as your cash surrender value. And essentially, this is kind of, you can think of it like an equity within your policy, and it's growing over time. So as you fund your policy and as you pay premiums, this cash surrender value is also growing over time. And it's a little bit complicated to think about because you think, okay, well, do I get that when I pass away? Well, no, you don't get it when you pass away. You still only get the face amount. However, depending on how you structure whole life, you can set it up in a way where your face amount grows over time. So maybe you started with $1 million face amount, then it grew to 1.2, 1.3, 1.4, and it continually grows over time. However, with this cash surrender component, you can take various different types of loans against it. And that's where this investment strategy of life insurance comes in. And I'll explain a little bit more about that later in this video. However, you just need to know for the time being that within a whole life policy, there's something known as cash surrender value. And you can think of it like the equity within your policy. If you cancel your policy, they have to pay it out to you. You can take a loan against it and it grows over time. Okay, so let's talk about when does whole life insurance make sense. So the number one reason why whole life insurance or any type of permanent life insurance makes sense is for estate planning. Like that's number one, first and foremost, the main reason for permanent life insurance. And so what does that mean? Well, maybe you want to leave something behind for your children. Maybe you want to leave something behind for your grandchildren. Maybe you want to leave something behind for charity. Maybe there's some type of cause that you're a part of or you support within your life. And you say, well, you know what, when I pass away, I want to leave them a lump sum behind to help fund their efforts because I really believe in this goal. That's one of the big ways that you can support it is through permanent life insurance or whole life insurance. Now, with estate planning comes a few other things, such as the taxes upon death. I mean, that's one of the biggest things. So essentially, what happens when you die is everything that you own is what's called deemed disposed of. Well, what does that mean? Okay. It means you didn't sell anything. However, you're going to pay taxes on everything as if you did sell it. Okay. So here's the thing. There are a few exceptions because you're probably thinking, oh, wait a second. If I die, this other person passed away and he didn't pay any taxes. So there are a few exceptions. So your principal residence is not taxed upon death. You can pass that down to your children. You can pass that down to whoever you'd like, and you're not going to pay taxes on it. However, if you own a second vacation home or a second property, that's when you would have to pay taxes on that property, and it would be capital gains. So it would be whatever the current value is minus whatever you bought it for, essentially at the beginning, that would be your capital gain. So maybe you bought it 20, 30, 40 years ago, you bought it for 200 grand, and now it's worth $1 million, meaning that you now have an $800,000 capital gain. And in Canada, that's taxed at 50%, meaning that $400,000 of that would get added to your income. And there's a final tax that's due upon your death, and that would get added into that year. And essentially you would have that plus whatever else is in your estate. So you can see as you start to add all these other items, maybe you owned a second vacation home, like I mentioned, maybe you own shares in a business, maybe you still have some registered investments or non-registered investments that you have to pay tax on. So when you start to add all these things up, all of a sudden it's like, oh, wait a second, I'm going to be paying $200,000, $300,000, $400,000, $500,000 in taxes, whatever it is. If I passed away today, maybe I should get some type of permanent life insurance so I have liquidity upon death and we can just pay those estate taxes off. We don't have to liquidate the second vacation home or the property, the cottage, whatever it is. We don't have to liquidate our investments. We don't have to liquidate anything to try and pay for those taxes. We have liquid cash. I mean, that's essentially what life insurance is liquid cash upon death. That's one of the biggest reasons why you would buy whole life insurance for estate planning. So you have liquidity upon death to pay for those final taxes. The second biggest reason why you might want to consider buying whole life insurance is you have a disabled child. So if you do have a disabled child, here's the thing. It's not like that is going to end at age 18 or 19 and they're going to be on their own and be financially stable and take care of themselves. You are going to, one way or the other, be financially responsible for them till the very end. And so having some type of permanent life insurance in place that's not only covering them for a specific period of time, like I mentioned, term would be good for, but also this is going to be a lifelong thing. So it doesn't end when they turn 18 or 19 or 20. You're going to want to leave something behind so that you know they're taken care of for the rest of their life, regardless of what happens to you. So if you have a disabled child, considering permanent life insurance is a really good option to ensure that if something happens to you early, okay, they're absolutely taken care of, but they're taken care of until the end of your life, whether that be age 50, 60, 70, 80, 90, or 100, it doesn't matter. That is another really important reason to buy permanent life insurance or whole life insurance. Now let's talk about the third reason why whole life insurance and when whole life insurance might make sense. And you've probably heard this before. Well, maybe it's a good idea to invest in life insurance. Okay, so I have some very strong opinions on this, and I've made another lengthy video describing exactly how this strategy would work and all the complications that arise from it, and compare it very easily to a traditional RRSP apples to apples comparison. And if you're interested in that video, just drop a comment below and I'll send it to you. However, here's the thing. Investing in life insurance is a very complicated strategy where you're essentially going to dump a large amount of funds into a type of permanent life insurance policy, whether that's whole life insurance or universal life insurance, you're going to grow the cash surrender value over time. And then eventually at some point, you're going to leverage, what means borrow, essentially cash out of the policy and use that for a variety of different purposes. You could use it to fund your retirement. You could use it to put it into another investment, in which case you may be able to write off the interest on that loan, as you will be paying interest. So there's a lot of really cool things that you can do with this strategy. It can be very beneficial for very high net worth individuals as well as business owners. There's a lot of really interesting strategies that you can do with corporations and buying insurance in a corporation and leveraging that insurance for very tax efficient strategies. One of the coolest things that you can do with this strategy is you can use this as a buffer asset. So what does a buffer asset mean? Well, let me talk about that a little bit here. A buffer asset is essentially a non-correlated, a non-market correlated asset that you can essentially have in your portfolio. What that means is, well, if the market goes up or down, like the S&P 500 or some type of ETF or some type of index fund, your buffer asset is not going to be affected. Well, what's the value in that? Well, let's just take a very simple example here where we have someone, let's say they have $1 million in investments, they're age 60, age 65, they're looking at retirement now, and they're invest into some type of fixed income and bond portfolio where, you know, they have some moderate to aggressive risk ratings, and it goes up and it goes down. Okay. Now, once they actually start to pull an income out of this during retirement, you're going to want to revisit that portfolio because you're not going to want to stay invested in such volatile portfolios that will go up and down, because if you pull an income from a portfolio that's in a down market, it will take significantly longer to recover than if you would just let it be and leave it alone. So the idea of a buffer asset is to have a non-correlated asset, and it could be a variety of different things. It could be real estate, or one of the really good ways that you could achieve this is through life insurance, because it's a non-correlated asset. When you have the market go up and down, that doesn't affect the cash surrender value of a permanent life insurance policy in the slightest. It stays exactly the same. And so the idea is, if you have a portfolio, instead of just transfer it into some type of low interest bond where you're making 2% or 3%, you can leave it invested into a portfolio that's still earning, let's say 5 to 8% or 5 to 10%. And then if you have a down market and you still need to pull your retirement income from that portfolio, you can leave it, you can let it breathe, and you can pull from the buffer asset to essentially supplement your income during those years while it's recovering, and it will recover exponentially faster than if you would have pulled an income from it when it's in a down market. Now, with all that being said, when does this strategy start to make sense? It starts to make sense when you've already taken advantage of all the other investment strategies that are out there, just the traditional, easy to understand, simple, and proven strategies without all these other complications such as your RRSP, your TFSA, and paying off any high interest credit card debt. Those three things need to be achieved long before you ever start to think about this strategy. There's many complications that can arise from this strategy, and a general rule of thumb is the more money that you put into this strategy, the better it's going to work, because you'll have a better chance of achieving a more preferential loan when you start to take a loan against that policy. So what does that mean for the vast majority of Canadians? Well, if we think about it, the vast majority of Canadians actually don't have their RSP maxed. They don't have their TFSA maxed. They are still holding a lot of high interest debt, such as credit card debts or lines of credit. And so I would say this, for the vast majority of Canadians, I would not recommend this strategy. For the minority of Canadians that are high income earners of Canada, or business owners, again, that are high income earners of Canada, this could be a really good strategy as long as you make sure you know what you're doing and you have sufficient income to warrant it, and you're working with an advisor that really knows what's going on and is going to be there, not just for when he sells you the policy, but for when you actually need to leverage against the policy 20, 30, 40 years from now when you're in your retirement. So I hope that answered some of your questions about when is whole life insurance worth it, or when does it make sense. If you guys have any questions, feel free to drop them in the comments below, or of course you can book a call through my website. And if you guys wouldn't mind, if you are enjoying this content, all I ask is that you give it a thumbs up, and I'll see you guys in the next video.